Good morning, beautiful people of the internet, and welcome once again to our Sunday special. We have a challenge for everyone today. If you can see a Mr. Ross Harper stumbling through the streets of London anywhere today, just go onto our feed and let us know where he is. We're going to try and plot a course from which bar he started at to which bar he finished at. Hopefully, he's had the best time of his life. He normally
Has he
does when he's in
downloaded
London.
Strava, mate, like we told him to? Is that
That's it. We'll find him. Don't you worry. We'll find him. But as always, joined by the amazing Adam Lawrence, the hilarious Helen Chorley, the pious Piotr Rusinek, and the joyful Jay Howard. We do have another guest hidden in a seat in the car. That's it. The Radagastial Rod Turner, who is definitely
the rascal himself?
There he is. So I think I read the Sunday supplement, and I don't think you were pulling any punches there, Mr. Lawrence. So not like there weren't enough kind of targets to throw punches at. There's plenty going on. So should we do a quick cliff notes of the?
For sure. Yeah, there's it's not hard to find content to write about at the moment. That is absolutely true. And the Bank of England did what economists do this week, I suppose, in a very bloodless way. I didn't put it in the supplement, but if you'd watched the webinar that I was watching with Pete van der Ven, they were smiling as they delivered the number of people who are in the crosshairs of variable mortgage rates and all the rest of it. And it's a very simple conversation for them. Inflation hurts everybody and can do some real damage. And on that subject, we haven't really seen any of the massive damage that it can do in terms of social unrest and things that are going on in other countries that are battling with it even more than the UK is. But 2.5 to 3 million people by the end of next year could be on variable rate mortgage deals, and there you go. That's sort of the bank stopped short of saying it, but that's their problem, really. Or to an extent the government's problem, because of course higher unemployment, higher requirements to supported living, all these things that we know are in an absolute ton of trouble already. Then the bill lands with central government ultimately. So that's where they're at. They're cracking on with interest rates upwards. Job market hasn't suffered too much yet. The sensible, the pragmatic, the people who remember what it is to be a central banker, and I think COVID has made it harder because central banking is about being calm, taking time, making considered decisions, and it's really supposed to be about communicating and shaping and all and at the moment it's just about reactive gathering pace rises in rates. Obviously the US Fed has gone 4 times at 0.75, and remember that the incidence period of this is known to be between 6 and 18 months. So how do you see it having? It's not going to have an immediate impact, and we've gone from positivity to blind positivity to, I think we've gone beyond reality though, mate. So I think we've gone to negativity to try and rein some of the spending in from the people, which I can sort of understand. And then budget wise, what does that mean for us? Well, I say us in the knowing that some are offshore residents, and I'm saying this trying not to be jealous of that, as I always do. But the UK tax system, let's say, is not changing for the better. We're going to see more tax rises when the budget comes. I think there's a real squeak of CGT this time round. I think it's really in the shaker. There's a danger of that was a crazy message this week. The idea, I didn't even put that in the supplement because I can't get my head around it. But the fact it's even been mentioned, that's the removal of the exemption for capital gains tax on your primary residence. There was a headline saying, well, it could raise 30 billion. But I mean, I wouldn't want to be an estate agent, look at it that way, because if you ever want to see transaction volumes grind to a halt when they're already going to go down significantly next year, try doing that. I I don't see it being
value of say today moving on rather than what you paid.
They couldn't. Rod
It
saying,
won't happen.
yeah, you can't apply it retrospectively, is what he's saying. Really, you'd have to do it going forward. But either way, it's a funny thing because if you look at other westernised economies, it's about 5 to 7% in frictional costs normally to buy a house, something around that level. Sometimes up to about 10. That's about the frictional costs. Obviously, our highest rate of stamp duty is still 12, isn't it? Well, unless you pay the additional, in which case it's 15. So that's already there at the very high level, but at the lower level, obviously, possibly the only good thing Liz Truss ever did, apart from resign, was to change the stamp duty threshold from 125 to 250, which obviously will, help everyone moving forward who's buying anything. Doesn't matter to me who only pays 30 grand for properties, right? But it obviously lubricates the system at the bottom end, let's say, and doesn't cost a lot of money either, in reality, because a lot of the stamp. Rod, you did the stats on this, didn't you? What percentage comes from London and what?
Oh, it's kind of it's like over half of all stamp duty collections.
Yeah. So
that's why it always makes sense to lubricate the bottom half, Adam.
Well,
that's what you take out of that, Jay. That's what you take out.
Hey, you've got to keep the system moving, and without lubrication, the frictional cost could be quite damning.
Hashtag lubrication is life. I see what you mean there.
I mean, is there also not a question of quality? In quality insofar, quality in our politicians, and you can take that back 10, 15 years if you fancy it, and that's probably being kind. I don't think Major did much apart from his name sounded good. And you can also apply that to the Bank of England. I haven't seen a great deal of quality in the leadership there for at least 10 years.
Well, I think
tough.
it's not easy. But Andrew Bailey, I think, is one of those appointments where his face fit and he'd done the legwork and he was in, And I think most people who work in the city would tell you they don't think an awful lot of him. They haven't formed this view in the last few months. They never thought a lot of him. And what's been shown, weak leadership really is part of the proposition. And you do worry about how many of the decisions going forward are more political for him than economically sound, So I think they've still got some really talented economists on the committee, and you can see, I put in the supplement the vote was 7-1-1, so seven people with the governor, 6 with the governor and him, and then the 2 doves who are saying, well, hold on, do we need to go this much this quickly? They're effectively saying, they think the US is making a mistake. We don't have to go, since the beginning of this year, we've been.
But it's easier to go higher now and drop it back than it is to chase your tail.
No, I do agree with that, but the danger is it'll take too long for it to kick in before it may. So, like Tenrayro, for example, what she is effectively saying is, look, gradual still sends the message that we're raising rates, but this will do economic. Winter next year, we could look pretty sick on the back of this. We can't see in real time what it does to. Well, the first thing we can see is vacancies, and we don't get a big lag on vacancies. Indeed, is still at about 40% above. Adzun is about level with where it was. So there's quite an interesting graph on the ONS. I mean, quite interesting for me, but it shows where the job websites, where their volume is apart from anything else. And the volume has come back down a bit, and that filters through into the ONS vacancy figures. We're down to only 1.15 million job vacancies or whatever. It could fall. That can change very quickly.
I think you need to take a glass step though, because you've got kind of what's their mandate? It's to bring inflation into line. So
sure.
Everyone keeps talking about recession, but the reality is a recession will negatively affect far less people than long-term inflation will. It's not a vote winner. It's not a political vote winner on a 4-year kind of policy basis, but a short sharp shock of a recession will be far better for the larger amount of people than inflation.
I do agree with that. But in order to make that happen, what you would have had to do is more stronger messaging early, rather than
the Mark Carney kind of view of Bank of England telling everyone kind of what they should do without telling them. Kind of thing.
Whereas all that's happening now is reactive chasing its tail that will have an impact that's too late, because the recession is unavoidable anyway.
But that's because government haven't spoken to them. And so I get it's a difficult thing for them to do.
All right, in the last 6 weeks, but not in the last 18 months. And, Haldane was saying put rates up in September last year, and Haldane was bloody right, and he was bloody good. Luckily, Hugh Pill's pretty good as well. Go on, Helen.
That was the bit that really struck me, that I think most people, well, I think perhaps like just in general, we miss or we forget, is that the steps that are being taken now. How long did you say? 6 to 12 months?
6 to 8. 6 to 18.
Yeah.
Sorry.
6 to 18. Yeah.
Follow through, and because we see when the changes get made at the Bank of England, that they get reflected really quickly by the mortgage companies. I think we think generally like, oh, it happens and the impact is not, but it's not to the bigger economy. Just because you see this immediate impact now doesn't mean that is the biggest impact. That has not hit. That is still to come. And I think that is something that people miss or don't appreciate, because it's the same as anything. You overload on sugar today, you get diabetes in 20 years' time. Unless the effect is near to the cause, people kind of discount that, and they don't fully understand the impact of this today.
It's a matter of orders of impact, really, isn't it? The consumer market gets felt first, right? Because the mortgage company's going to change, prices in shops go up, and that stuff moves quickly. It's the second and third orders that take longest to move the ship around. And following on from Rod's point, which is actually really good, we're going to need a central bank and a government that are going to start acting for the benefit of the country rather than what's going to win them votes. And unfortunately, I don't believe it would be in better hands if it was with Labour, the Liberal Democrats, the Greens. People who have power will do anything to hold it and control it, right? And that's the problem that you have. You have very weak characters, morally and in every other way that I've seen so far. And the whole thing is, let's hold on to this thing. Let's try and retain power. The Conservatives. Sorry, the dog's got kennel cough. The Conservatives are not going to hold power. It's just not going to happen, unless they. Yeah,
the benefits of kind of a dictatorship are
the autocracy comes in.
Are what you see in places like China, for all their faults. What they do really well is have a long-term outlook on infrastructure spend. And other countries as well. It's like the most frustrating thing for me that the UK never did was get a sovereign debt fund, or a sovereign wealth fund, sorry, to pay things, which are things like that you've seen in kind of Saudi and Norway and things like that, which have just been absolutely brilliant for the whole people. But as a political choice, thinking 4 years or 3 years down the line will we get voted in, it's just a non-starter. Why bother with it? And that's where actually you need this long-term outlook and cross-party kind of agreements and things like that, which are very difficult to happen, and no one cares about those at the political league.
I think that means if there's a change of party, then what happens is the party that comes in spends the first 2 years undoing what the previous party did.
The point that and also sort of bringing it right back round to property. One of the things that I think we've learned during COVID or since COVID is that the cycles are too short. So who are the people who are going to be in the most trouble in the next 12 months because of their mortgage rate, bringing it back to that? Well, it's the people who took 2-year products rather than 5s. Yeah. But the reality is, like you say, 5-year cycles are not it's not particularly a long time. It's a lot of time for us as an individual human being, but it's not a long time in terms of a political or an economic or a business cycle. And I was having dinner with a friend of mine this week who is an ex-investment banker who does hedge fund research, and he's a European high yield debt specialist. And we've had some very, very interesting conversations about a few companies, which I won't mention on air, but let's say one or more of us may or may not have done a significant amount of business with them. And where their bonds are trading at the moment, for example. But this 5-year cycle that we all live in, and I've always talked about trying to line up your mortgages so not everything drops off at the same time and exposing yourself to the interest rate on the 31st of March 2024 or whatever it is.
It's never good when you expose yourself.
One of them is enough. Okay, two is too many, right? But that's the old don't take risks you don't get paid for. Because if you load that risk in due to your financial naivety, apart from anything else, you're not going to get a lower mortgage rate for the privilege. You're not going to get any of those things. You're just taking extra risk. So depoliticising, and they've talked about it with the NHS, haven't they, for many, many years. But depoliticising and taking out of the cycle a number of these things, and they've tried to do things like infrastructure, national infrastructure banks, and whatever, but it's not good enough.
Well,
other countries come in.
It's one of the things that he tried to do.
COVID got in the way of. No, I totally agree.
He's any good at anything. No. One of the things that was probably more positive about it.
Mate, I think Boris and Trump are both Keynesians. I think neither of them know what that means. And that's a good thing in a time of extremely cheap debt. The problem is the ship's now bloody sailed.
Well, I think that's an incredibly important point at the moment in terms of property. And for the last 14 years, where if you look at the total returns of a property investor, over the last 14 years, probably 95% of those total returns have come from capital value, i.e. adding value or capital uplift. And I think there is now a massive shift coming where actually the focus needs to be on rental growth being a majority kind of stakeholder in your total returns. So I think that's a really kind of important point for people to realise is where does the majority of total returns from the property investment come over what period of time, and what's it going to look like for the future? Because from my mind, where I've been quite kind of bullish on places like London and things like that, where I've focused more on kind of capital value, my focus is definitely starting to change a fair bit as to actually where can I see more uplift in rental, because that's taking a larger proportion of what I forecast my total returns to be over the next few years. So I think that's a key kind of point.
I think that really is probably defines quite succinctly what the beauty of property is as an asset class, because it has that flexibility to provide. I mean, stocks and shares also have that flexibility.
The great thing about property is you can engineer it to be a commodity because of its use, i.e. you live in it. It can be private equity, which for most of us it is, because that's how we're kind of utilising it, or for the institutions it can be fixed income. So it's whatever you want it to be. And it's how you engineer that. The problem is a lot of people do not realise what they're using it as. And many people think that they're using it as fixed income, whereas actually in reality it's more private equity. And I think that's important for people to understand where in their total kind of portfolio of wealth, where does property sit? And once they focus on actually, is it my private equity? Am I kind of actually getting the most of my returns for example, over the last 10 years, the majority of returns would have been, say, over a 5 or 7 year period, rather than actually over a 12-month period. And when you work back your IRR, it looks really great, rather than working kind of on an annualized return over the first 2 years kind of thing. And I think the way people have done it on that private equity basis is going to be changing now, whether they know it or not. And I think it's important that people understand where that sits for their own will.
Yeah, really, really good point. It's a good job he's in the car, isn't it, eh?
Well, and what do you think the people should be focusing on in the next sort of what kind of how to make sense of property deals, because we see a lot of people in auctions.
Yeah, I think it depends on what they want property to be for them. Like I said, if they're and I think that's a really, really important question for everyone to kind of ask themselves, is what do they want property to be in terms of as an investment? When do they want their investment to mature? Are they looking to be in this for the next 10, 5, 20 years? And do they want their capital plus return back at that point? Or are they looking for it as, I don't know, a fixed income basis?
They're looking to live out of their portfolio. Exactly. Yeah. A job replacement. Look, a lot of people, like it's sold as by the wealth creation.
That is the big
people.
Thing. It's a terrible. Yeah. Property as an asset investment class is not a good thing for that, unless you've got a huge amount of money and you're willing to live on fixed income in terms of a 4% yield or something like that.
This is it. You're going to see, if you think about the way that large corporates operate. Going back to my conversation with my friend the other night. He was saying about, they'll take annual debt that will be about 5 years long in terms of the duration. They'll sell the bonds in the city. So they work on a very similar cycle, and they use all of those tactics where they don't let it all mature in one time, and all the stuff that I've been talking about for years, really. But the thing is, if they issued in 2018 £200 million worth of debt at a 6% coupon, which at the time was deemed to be relatively high yielding, and they come back to the market in January 2023, and they need to either roll it over or they pay it back, right? That's their choices. And it's not like they don't have money. Of course they have money. They have working capital, they have reserves, they do all the sensible things that businesses do. But there's the 200 mil that's up for refinance. Do you want to take it back out of 12? You fancy a bit of 12? And if you are, then if you're servicing the debt on an interest coupon basis, which they are, you can only take 100 million because that's the affordability crunch. So where's the other 100 million coming from, guys? Pony up. And the problem is, as the duration, and this is kind of back to the interest rate, do we go up and down, or do we try and get up relatively slowly but send messages, which is better central banking in reality? Although I would have been in favour of one. Having said that, I would have been in favour of being hawkish this time around and going 1% and sending that message, but then saying, do you know what, we're probably looking at 0.25% next meeting, and I'd be giving more forward guidance as to where we think things are going. But I don't want us to overshoot and then come down. I want us to get up to where we need to be relatively slowly, because that's how central banking bloody works.
Well, you're also seeing
I think
you're also seeing on an international basis how international markets are reacting to these things, right? So by overshooting, there could be an overreaction, or by going up 0.75 and then dropping down 0.25 in 6 months' time may have an overreaction. There is like a hypercritical kind of viewpoint on the UK at the moment. So
I think as property kind of investors, people need to understand the difference between base rate and mortgage rates, which are very, very different. So I put a post out the other day kind of about the fact that just because base rates going up can be a very good thing for mortgage rates for a 5-year fix, for example. When you see one of the reasons that swap rates and the 5-year gilt has dropped since the Bank of England actually put rates up is because the markets expected it to be a 75 basis point increase, but they expected more of the committee to put it up, to vote for 0.5. And actually less did. So that gave the market confidence that actually they want to tackle inflation, even though base rates are going up, that actually in 5 years' time the base rates will be lower because of what they're doing now. So that then translates to 5-year mortgage products being lower because the base rate is going up, which people, I think, struggle with to realise that a lot of the time. So what the best thing for a 5-year fix would have been if they put it up by 100 basis points, because that would have initiated actually a shorter, sharper shot to bring it down. So
it's about it's about the intentions that it signals as much as it is about the 100 basis points.
People need to understand that actually. If you're on a tracker that mimics the base rate, yes, it's going to go up. But if you're looking at getting a 5-year fixed term mortgage, which is the most popular mortgage product out there, then actually a higher base rate can be better. And if we look back to, I think it was 1990, last time the Bank of England base rate was 6%, the typical mortgage was 5%. Because as interest rates or base rates grow higher, banks get more of their margin from taking deposits and lending that than they do from borrowing on swap rates.
That's exactly right. The last time base was 6 actually is 2008, and the average mortgage rate in 2008 was 5.24. Exactly reinforcing that point.
Because banks will, I don't know, get savers to deposit money and give them a 4% interest rate, and then they'll lend it out at 5%. They're making that's 25% on their money margin that they're making. And base rates might be 6%, but that's not where they're getting their credit line from. No. And this is what people forget, rightly so, because for 14 years we haven't had it because base rates have been bugger all. So we're going back into a realm of actually when banks have the opportunity to get their credit lines from different sources. And so people forget that actually base rates are not everything. A bank like Shawbrook, for example, will get 50% of their margin from deposits. So they can afford to bring down that base rate. And then
will you let them specifically know, please? Because their rates are far too high.
Well, as an example.
I know.
Interesting. And do you guys want to hear the real results of auctions in the last week?
That would be great.
Especially that was the also presidential one, because that was held on the day of the Bank of England meeting. So they had a really big catalog, 243 lots, and they only offered 155. So almost 100 lots got withdrawn, like 92 or something.
40 odd percent not offered, basically.
Yes, and they sold 97 out of the 155 offered. So headline figure 63%, the real figure 39%.
Wow.
The reality is that the real figure for auctions, if you include what they started with to what they sold, is anywhere between 55 and 65% in real terms. Obviously,
that's a very
friendly
thing.
Yeah,
Friendly.
it hasn't dropped below 50% for a very long time for most auctions.
But I guess a lot of people a lot of the auction houses have taken on instructions, and then with the beauty of kind of online auctions where they know how many people are interested, i.e. how many people have downloaded a legal pack, and they'll then withdraw them. So they make their numbers look better by withdrawing a load of lots before it gets to auction.
A marketing exercise rather than a measure, which obviously is what Piotr's doing there.
Exactly. What, like you say, how many actually go in or get instructed on the catalogue versus sold, rather than what's done on the day.
That's right. Well, it's also commercial had slightly better results. They actually had about the real kind of figures, and they were held 2 days before the Bank of England meeting. So they had 180 lots initially. They offered 119. So again, like 60%.
Wow.
And they actually sold 83. So what's that? 83 by 180. It's like 46% basically.
Wow.
So it's not too bad.
I heard a stat. I don't know. You'll know more. But is the Barnard Marcus auction that's coming up. Hasn't it got something like 400 or
450 lots.
200
Yeah,
of them have been moved forward.
I know. I mean, we wanted to offer one lot in the November auction, and we kind of left it quite late. And I called them up, and normally they would take on pretty much any lot that we say. And he's like, we can't offer November. We can do it in December, because if we take on those 2 lots, that would add 8 minutes to our auction, and we don't have any second left.
Yeah.
Crazy.
Yeah.
I mean, the other thing that's interesting, we wrote an article for Property Investor News magazine. The deadline was 2 days ago or whatever. And I said, so the title is Go Big, Go Bigger, Go Even Bigger Than That, or Go Home, because it was basically a reference to how big these auction catalogs are getting. So I thought I'd do a little bit of research. I went back onto EI Group and I was saying, okay, what are the biggest catalogs that have ever been offered? November 2008, over 2 days, Allsop residential, 595 lots. Right? Then you see up until the following year, everything was over 360 lots. Then it started to decline, right? Because the market started to stabilize. You're starting to see similar things here. The catalogs are starting to swell, which means distress is starting to get heightened.
What was the percentage sold of those, of say when they had 500 and 300 going?
About
it would be
63%.
Okay,
then, which
Not
is
bad,
probably 20% more than it should be in real terms. So
Well,
it's probably the same kind of return.
What I was going to say was, if you think about where the world was in November 08, the cat was firmly out the bag on the operating table with its guts out. Whereas right now, a lot of people are individually thinking, well, before the knife falls, but the knife is falling before it's actually fallen.
But I do think now there's information is gathered a lot quicker than it was then, and so people are thinking they're getting on the front foot by it. It'll be interesting to see.
That would be predicated
it's a sword of Damocles.
All auction vendors are sophisticated, which we know they're not. You know, I think fear of something happening is worse than it. Generally,
that's what I was about to say. It's a fear of Damocles market. It's something is definitely hovering over the heads, right? And there are those that have been exiting the market for the last 4 or 5 years. You know, exiting landlords or retiring landlords or accidental landlords. You put those 3 together, that makes a big chunk of sales in auctions. And has been for the last 3 to 5 years.
If you think in a relatively unsophisticated way, you would be looking at that thinking, oh, blimey, I've finally had that capital growth bump. You know, the last decade has been relatively slow. If you're not in London, Bristol, Oxford, Cambridge, you know, it certainly hasn't done what you hoped it would do. Where was that when, you know, whoever told me it was going to double every 10 years? It didn't do that between 2010 and 2020, right? But then suddenly, boom, 25 to 30% in 2.5 years. Quick, I don't mind if I give 5 or 10% of that away if I can cash in on it. But the problem is, with that sort of seesaw going on in the auction market, 5 or 10% ain't going to cut it, mate.
Enough.
It's going to be, it's 35%. So to get it sold.
There's another difference in 2008 where there is a massive kind of amount of finance out there at the moment. So a lot of people have a lot more sources of funding than they did then. So I think that will help prop things up as well. Versus the prop that we had then.
I had a similar conversation with someone recently. They're like, oh, you know, where are all the repossessions? Where are all this, that, and the other? And I said, well, you're looking at 2 very different lending markets from 07 to 2022. 07, you were looking at 125% loan to value to do your refurb and all that kind of stuff. And now you're looking at down valuations for the last 18 months. Most banks have been knocking 10% off the top.
I think there's an important point here where what was the bank's motivation to repossess, i.e. get their money back in terms of what else they can put it into. And I did a podcast, obviously I'm going to have to plug it, the podcast.
Plug it.
Didn't realise, hadn't heard.
All right, plug it. We've lubricated the bottom end of the market. So
listen, let's lubricate further. But he brought up a really good point.
This is salty chat for a Sunday morning, Roderick, I'll tell you.
I mean, he brought up a really good point in terms of, well, the bank's willingness to kind of get their money back at that time.
Sorry, the windows in the car are steaming up. Hold on a second. Sorry.
What they could put it into. So where you've got 0 or very low interest rates at that point in time, well, what's their capital going to return them if they go and put it out to market? Whereas where you've got a risk-free rate of, say, 3%, suddenly that's a little bit more motivation for banks to take their money because they can go and put it into better work somewhere else. So it's going to be interesting, but at the same point in time, you've got a lot of kind of capital out there looking for a home to give them, I don't know, a return of any sort. So you've got kind of two conflicting things.
I think that's incredibly interesting because you can imagine a board meeting, for example, at the moment in a big lender where someone's from that point of view and saying in terms of new business and all the rest of it, and then someone's from the point of view of, well, reputational risk is going to be key here because we lost so much in 2008 and blah, blah, blah. So people won't necessarily want to jump first, but this is where you get these kind of near cartel. I mean, if you look at the event we ran on Tuesday night about the mortgage market in general, you know, we had some quite big players in the specialist lending market on the call. Now, it's very easy to see where they were doing a panel together. They all know each other. There's a lot of banter. You know, it's very clear. They have their WhatsApp group, right? There's a bit of chatting. It's very, very clear that is. And, you know, you think, well, ultimately, they can nearly all act together, not in a formal cartel kind of way, but if we go, you go. And that will be the case at the very, very highest levels with Deloitte and the Barclays and all the rest of it, you know? So there's not a lot of safety in, well, I think if you summarize the last 25 minutes of this chat, you'd say the world's changed. You need to get used to how the world has changed. Think about what property does for you and what it means to you, right? Don't expect, and this is one of my big fears at the moment in terms of where duration of rates rather than peak and trough, because I'm not too bothered about that. It's just what everybody talks about, so we talk about it.
Timing the market versus timing the market has never been more important. Actually, timing the market is vital.
But one of my big fears is people, and I mean, you know, at our individual level, at the organisational level, at the governmental and central banking level, benchmarking what's happened over the last 14 years as having any relevance right now, whereas I really don't think it's got that much relevance at all. And where you are is between the world where the base rate used to hover between about 3.5% and about 6%. So thinking it's going to go back down below 3.5% for me, for any sustained length of time, I don't think is realistic. But on the flip side of that, I also think that if inflation was 4%, it wouldn't be causing the problems that it causes, and the government wouldn't bloody mind because there's so much debt. Now, they can't come out and move the target to 4% because that would be a very damaging and difficult political exercise to pull off. But if they could get it down to anywhere near that, I think the hammer eases off the brake, so to speak, as the bank would call it. So there's still, and that level of uncertainty still exists for, you know, the next 12 months. This is supporting what we've both been saying for a while. Transaction volumes are going to fall off a bloody cliff. They're going to fall off a cliff. You're evidencing that it's already happening. And if it was, what I find most interesting about that is, you know, part of my argument, and it's in the supplement this week, is around, look, don't listen too much to what was happening in October, because, you know, the trusterfuck, for want of a better word, was still in full motion. Right? But ultimately, that's over. Most people are feeling that Sunak's got a pretty good handle on stuff, and international markets certainly agree, and they're going to do the right thing in air quotes, which is still going to be quite shit, especially for those who pay a lot of tax already. But that's what they're going to do, and the faith's in them to do it. So that knowledge is all known by the auction market in this week's results, but this week's results look very, very similar to what was going on in October, if not a little bit worse. So investor confidence is on the bloody floor. But the other point is, you know, what's the number one thing people are saying to me at the moment at partners in property meetings or whatever. How do you? It's all very well by finding good deals. You can find good deals. How do we get out? How can it stack at 6% term? And it's like, well, it needs to stack. So the answer is one of a number of things.
I think property investors need to kind of when things get volatile. One of the great things that you can do is basically exchange debt for equity. So instead of taking on more debt and taking on more risk, give away more opportunity for reward in exchange for less risk, which is what giving away equity is. And you're seeing this at the moment with kind of institutional kind of property funds and REITs, things like that. What they're doing is they're going, well, actually, we're gonna take less debt. So we might be they might have on average over the last 20 years have been at 50% loan to value. Yeah. They might now be at 20% loan to value because actually the money they get returned from their equity is what their shareholders and investors want. They want that return, and actually they can take less. They can do it on equity rather than on debt, so it works out better. And I think you're going to see more and more people looking at property as a safe haven asset in terms of the yield that it gives and giving more and putting in more equity rather than total returns. Goes back to the point on kind of getting the renting increases being more of a proportion of total returns and capital uplift.
There's a couple of things on that. We discussed this briefly yesterday because we're so exciting while we were at the rugby. One of the things to bear in mind is obviously on a corporate level, debt has the benefit of being written off against your tax bill, whereas at a REIT level it doesn't because there is no tax bill. So there is a difference there, but it does make sense if you think like and I've done the very simple exercise. Well, what if base is 10%? Yeah, or no, forget base. What if pay rate is 10%? Right? What if pay rate is 10%? Well, I've got some money. I can put that in and get 10% returns on my money, can't I? So it doesn't cause me any major league problems. I can go out to investors and say, do you want, because if pay rate is 10, they're probably still only getting 5 in the bank. So I can give them 7.5 and we can all win, So there's always ways and means around all of that. But if debt has been incredibly good value and it's almost been you could have been a complete plank and made a load of money in the last few years.
When you take risk, what do you get paid for? How do you price that risk? And I think pricing debt as a risk at the moment is you've got to understand that how are you pricing that risk of debt? And so equity is looking a lot more appealing for I think a lot of institutional investors than taking on debt.
Part of the good news, I know that doesn't sound like there's been a ton of good news today necessarily, but part of the good news I think is there is that ton of cash that's out there that wants a home, that knows it needs to work even harder than it ever has done because inflation is ravaging. So therefore, the money is there to try and do those sorts of things. And whether that's at an individual level, that can boil down to, can you get it from the vendor? If the vendor wants, because the vendor's pretty touchy right now, generally speaking, right? Especially if they've just been in a 450 lot auction catalogue and didn't even get offered. Hello.
Well, we had like 2 or 3 situations in the last couple of months where vendors suggested, well, we'll take this price, but we'll give you whatever 100k, 200k as contribution to your deposit, whatever that is. So it's that kind of delayed in time.
Well, for them, they're thinking, actually, if I can finance you buying me out and take a coupon rate, that's a fixed rate of return. Even if it's less than inflation, what they're thinking is, well, I don't know, you look at the last 12 months, everyone banged on about, well, you need to put your cash to work, otherwise you're going to lose money through inflation. Well, you've lost a hell of a lot more if you put it into the money markets. So actually, it's return of capital versus return on. You're much better to lose it to inflation than you are to lose 30% on
stocks and bonds.
And it gets you back to that exit, though, doesn't it? It gets you back to that exit. These guys are saying, right, I'll take this price off. I'll give you that. I'll give you the coupon going forward, but I'm now out. I'm liquid again, which means I can dive into something else. Whatever it is that they're looking to do, they have that exit, and that's really important at the moment.
Well, because so much is unencumbered, which is back to sort of the bank's point as well. There's so obviously property values are higher than they've ever been before. That's self-evidently true, but also the mix of debt in general has decayed over the last 20 years quite significantly, and certainly over the last 14, because ultimately, you know, more money at a really simple level, more money, less money going out in interest payments mean more money can go on capital repayments for homeowners and asset owners and things like that, and they've been able to do that. The market has carried that and made that possible.
So what do you think the world is like for the property investors that have been sold the no money down, no money left in kind of tropes? What's the future of those kind of investments? Because as Rod's just said, I mean,
Helen's face. Refer to Helen's face for the answer to that question.
I mean, I keep saying to people are like, "Oh, I've only left 20 grand in the deal." I said, "Okay, so your ownership is £20,000 of equity, because the rest is debt. The rest is a pledge that you have to pay back, right?"
I mean, that is a nonsense metric to use in property investing.
It is.
Return
really
of cash employed is a trading metric. It's absolutely useless.
Mate, will you stop sitting on the fence? I told you this.
Tell us how you really feel, Rod.
It's
like a bloody politician.
It's one of the most frustrating things to hear. Talk about money left in. It's irrelevant. It's backward looking. It's happened. It tells you nothing about how the investment's performing right now. Tells you nothing about the debt. Tells you nothing about the risk. You can't benchmark it. It's a trading metric. Use it if you're getting in and out of something over a short period of time, not when you're investing in something over the long term. It's just nonsense.
I think it's great. I think it's absolutely fine. I think it's wonderful.
There's a recumbrance to these things. I mean, that being able to benchmark your investment over a period of time, something you've owned for 10 years is going to have a different return on investment after 2 years, definitely after 5 years, and then after that it should become
that is private equity, isn't it? That is what most people realistically are doing, and looking at, right, cash in, cash out, what's the annualized return, what's the RRR, and actually no one cares what it made in the first year, i.e. you buy an HMO with lovely nice teal cushions and bronze taps. Like, what do you get when you exit it? Or what do you get? What's the IRR over 10 years? And how does that benchmark against your typical ISA? I mean, that's the way to kind of really look at it.
Yeah, unfortunately, Rod, the majority of people that you either speak to or either at networking events or just on these Facebook property groups, which I know is a very infinitesimal number of property investors in the country, let alone in the planet. But no one looks at it like that.
I bet the groups are just for infinitesimal.
That's because you don't learn this. You don't learn this at a travel lodge in a weekend. You learn it at doing a degree in real estate, or like that's proper property investment.
But if you join us for 999,997 plus VAT, we did it in a travel lodge over a week, not a week.
Don't worry. The lunch is free. The lunch is free.
Yeah. What you need to do is
run to the back of the room with my credit card.
There's only 3 spaces left, Helen. Go!
How do you market your product? Well, you market your product to people who are financially vulnerable. And when everyone says, well, what's the difference between education and going to uni? Well, the difference is there's a benchmark of how you get into uni. And it's called, you've got to qualify. You've got to have a certain level of capability to be able to be let on the course. I.e., you've got to do A-levels or whatever it is to get in there. You don't at the back room of a travel lodge. You've just got to turn up or be on social media.
Another credit card.
That is the major difference.
I hope you're taking notes about our next course that we're just launching.
Interesting. We've got a couple of.
It's almost like you've read a chapter of my unpublished book. There's a lot of a lot of that.
We're gonna go camera off, which I know will disappoint all people listening to this call, but we're gonna have to start making a move, and we'll keep the mic open, but we'll go camera off, guys. Thanks.
Okay. Sounds good. Sounds good. We've got a couple of comments. Interesting. Priya was asking if it's mainly landlords selling properties. And that's number one question.
The auctioneers that we're speaking to, or that we spoke to no more than a couple of weeks ago, they're seeing the majority of the lots that are being put in their catalogues are by retiring landlords, accidental landlords, and just exiting landlords. Landlords that own the bulk of their properties in their personal name and paid no attention to Section 24 or all the other bits and pieces that have popped up since then.
Yeah.
A lot of HMO landlords in areas where they're going, where they're doing the council tax on a room rate rather than the building, and they just weren't prepared for that. So there's a lot of those kind of things that are disrupting and moving people out of the market. I mean, we looked at something that was going into the Lovitz auction on Thursday, and you could see, I mean, they put it up there as a 4-bedroom house. I mean, it was a 3-bedroom house with 3 en suites, which means it was probably previously an HMO, right? So you can see that there are people that are trying to undo the works that they've done and just sell the asset off. And the worst thing is, the majority of landlords that are aren't selling to other landlords. They're selling to other people, and that doesn't sound like it's a big deal, but realistically, it is. It is a big deal.
Yeah, shrinking the rental market hugely.
Yeah. I mean, there was that picture of people going to a viewing to rent a flat in Ireland somewhere. I can't remember exactly where it was, and there was a queue down the road, and then there's the pictures from like Shelter or whoever, where it's like similar kind of things, 50 people standing outside a house in London somewhere. But obviously I saw a video, it was on TikTok this morning, of 150 people outside one house looking to rent it in Melbourne. So it's a worldwide phenomenon. At the moment, there are people that are just exiting, and I'm assuming in those different markets and those different countries, there are different reasons for doing so. But the main reason for doing so in this country is it's not a landlord-friendly environment. Between the legislation, the compliance, and the taxes, unless you're going to be, a beast of 500-600 properties looking to build a REIT, and you're doing it in a professional way. If you're just I'm going to buy these because I want to replace my income, or I'm just going to buy these as a pension or whatever, it's harder and harder to carry that off.
Interesting. There's a good observation from Sam Fungo as well. He shared that basically, just to summarize it, basically also commercial auction was much better than the residential one, because most commercial buyers, 80%, were cash purchases, and most residential buyers they require finance. So it's that kind of affects the transaction.
You have to feel slightly more confident on the commercial rate at the moment because of the amount of people that are trying to deploy SaaS and SIP funds. I mean, obviously they can, in a myriad of ways, they can handle residential, but for the commercial, it just makes more sense. It's easier for them to buy in that environment.
Yeah, and Acutus at Great Auction, they had 41 properties in total. They offered 35 and they sold 33, so that's 80% rate.
So they don't do what other auctioneers do. So you have some auctioneers that will take on, of their catalogue, they'll know at least 40% of that catalogue are absolute stonewall sellers. Then you'll have 20% of the catalogue which are 50-50s, and then you'll have 30% which you got a good feeling about it. You know that there's a marketplace for it. You don't know who that marketplace is or where they're coming from, and you just hope something will perform. And then you've got the ones that you just think, right, these are catalogue fillers. It's kind of like people filling up the bottom of the what's it called, the Christmas stocking or whatever it is. It's a Christmas stocking filler. And the chances are in a decent market, most of those will go. Acuitas aren't that company. Acuitas we're taking it on if it's selling. Right. They'll have to have some kind of confidence. There'll have to be something that comes up in the legal pack, or something else that comes out, or a reaction to a news story or politics or finance that kind of stuff will disrupt them. But for the most part, they're only taking on stuff that they have a great confidence level in it selling.
Yeah.
All the other auctioneers will be managing their catalogue through withdrawals on sold priors and postpones. They'll be managing not just their catalogue, but their success rate by doing that.
Yeah, interesting. Well, there's a few more comments. I guess we'll respond to those later on. And throughout the thing, I need to shoot, and Adam's already left. I think. Anything to add, Helen? As a summary from your perspective.
No, it's really interesting, especially for me because I've never sold anything in auction. To see how the different companies, how they operate. I think we can often fall into a trap of, it's like Rod would say about London, like you think about a London market, but it's not. It's all little different markets. And I think the same, you think of like auctions, but it's not. There's resi, there's commercial, and there's the way that different people do different things. So that's really insightful for people.
Yeah. Well, on that note, wish everyone amazing Sunday, and we'll be back next week. Hopefully, we'll find Ross by that time. If not, Rod will have to fill in again. But yeah, brilliant. Thanks, guys, for the chat and comments and everything, and see you next week.